What's going on, everybody? TGIF, huh? How's it going? Yeah, knowing where the walls are is helpful, but then when they get breached, it's like, okay, well, now what? You need something that can monitor that flow. Um, I can't remember what they have to see actual intraday flows compared to like spot gamma or even right here in the Discord being able to do, algo flows. So I just ran a command for algo flow and got that. You know what I mean? Like you got to supplement it with more information. I try to figure out why are we breaking out to try to figure out what tool to use. If it's 0-day options flow that's driving us higher, I want to watch the 0-day options flow, net flow, gamma flow, all that stuff. But if it's treasuries, bonds, and yields that's breaking us out, then I want to watch that, right? It really just comes down to trying to find why the hell are we moving, right? And then from there, what tool should I use? But we can't make the assumption that every day we can use options or every day we can use bonds or treasury or VIX or whatever, because the reason we're moving changes. Yeah, nothing's ever going to tell you what it's supposed to do when it gets there, right? There is nothing that exists that tells you what is price supposed to do when it gets to A, B, C, D, because we have to determine for ourselves what is it supposed to do, and every time it's going to be different. If it's a call wall and there's a reason that we're going to the call wall, it could get there and blast through it and go even higher, or a put wall or zero gamma. Whatever the wall is or whatever the options level is, there's nothing in the world that is going to tell us in advance what price is supposed to do when it gets to that level. So at least it's not promising you something that it can't deliver, right? If they sat around telling you that it was going to give you the world, I would, I'd hate them more because I don't like those places that blow smoke at us and offer false promises. So what is the expectation when price gets to a call wall? That they monetize their long calls, right? So we expect to see a lot of short calls. And then from that, we get to extrapolate, okay, well, if we do see a lot of short calls starting to come in, what will that do to price? It will suppress price. It will, be a weight against us running even higher. So we can get to 6,400 because that is the call wall. It's going to act a bit like a magnet, but if we overshoot it and we try to go higher, it's got a parachute dragging it behind it, like trying to slow it down, like those cars on the drag strip that pop the parachute. So it can go higher than the call wall, but at what cost? And they're going to have to come in with extra work. We should see that in the options volume. We would see that in the flows. And if we don't see it, then it's very likely we'll stall out there and that we won't go higher because we don't have the additional options flow to drive us higher. Then we want to watch the calls to see if they are getting heavily sold. And if they are selling them, are they going into a new expiration? Where's the new wall going to be and where are they building it? Then we start hunting around trying to find that activity. If we don't see any of that, then it's likely we'll fall away from the call wall. I don't have that call wall. I have 6436 for today's call wall. Let me check, make sure I even yeah, I updated it. Different product, right? Different call wall. Well, we definitely have a lot of money coming in, and that's been the consensus across everybody, that we've got all this money that continues to push the markets, and we don't want to try big picture, shorting the Mag 7 and shorting equities and all that stuff. We just don't want to get in front of that steamroller. Mentor Q, or not Mentor Q, but a company called Voland has the most extreme tools for dealer hedging dynamics out of all the products that I've come across. They're more extreme than Spot Gamma, um, Trader Vol, all of those guys, Mentor Q, all of them. The thing is though, it is a very complicated platform. I mean, it's really complicated. I thought I was a an options nerd until I met the founders of this place, and they have some really amazing tools. And recently, they put together some kind of a academy to teach people how to use their tools. I haven't went through the academy yet, but it's pretty interesting stuff, all things considered. And their ability to monitor things intraday is absolutely amazing because they are calculating everything, every trade, and they don't make assumptions, right? They'll go in and they'll look at exactly how it was traded. Interesting stuff, they kind of nerd out on it, but the thing is, if stuff changes intraday, it's one of the starting places for what could happen next. I'm not seeing anything. We got a lot of mixed info, as we should. I mean, it's 2 o'clock in the afternoon on a Friday. There's not going to be some standout level, but a lot of times, if you're looking farther out in the day, say it's around 10 a.m. and you've got hours to go, then there's something worth reading there. But no, it doesn't have what I'm looking for. Not this late. I guess it helps if we do look at SPY rather than block. So it's harder to climb the mountain, as they say, or it's harder to climb the hill. If we look at Vanna exposure, it's just hill after hill after hill after hill, but it does have flat areas in there. So for an example, if SPY could, make it through the flat area here, that's 639, pretty easy. But we'll have a hard time getting from 639 to 640. We'll be able to go from 640 to 644, but another really hard time trying to jump up to 645, and then again from 48 into 49, another jump. So the flat areas make it easier. Or if we were headed downhill, if this was curved the other way, then we'd be able to fall down the hill easier. Like if we were starting here at 618, we could definitely fall down the hill faster to 603. See what else we got. What a Vanna Vanna exposure falling down the hill. A little bit of uptick into 639, but a swift drop down into 43 afterwards. What expiration was that? 30 days. We want something a wee bit closer. Next week? This week. This week. There ain't much left of it, but let's look at this week. Yeah, steep climb from even 37 to 38. Boy, it's a leap to get up there. Let's look at how much damage we have to get through. Zero-day dealer adjusted premiums 3.5. I'm sure there's like an abbreviation for how many zeros are behind it. Net zero DTE dealer premium 100,000 million, 134 million, 100,000 million billion versus 59 billion in net dealer premium. They don't have a lot of dealer premium left to unload on the day. 100 million. And their daily hedging is running at about 1.6 billion daily. If they're only looking at 134 million to finish it up, then they're about done. Zero DTE charm headed straight down. We could get to 639 pretty easy. I can't look up ES on this, but I could put in SPX, and kind of get an approximation that way. That's all expiration Vanna. That ain't going to help. Today's Vanna. There we go. No, straight up. We'll see if the Gex flip point has changed. All right, SPX Gex flip point 63.9386, and that is for today. It's a 0 day. And a big level at 6,400, which we all know, right? It's not a surprise. Microsoft breached one of its wall targets. So it had a whale, what they call whale targets overhead, and it broke one of those whale targets today, 517.38. No, 515. Nice breakout on the day too for Microsoft. That's supposed to be a short, and it didn't get the memo. It's just moving on up. But you can see the dealer deltas are shrinking, right? They were deep in the red, and now they're heading back towards zero. To understand this, just to keep it as non-complicated as possible, think of it from the position of, if these are the dealers, then who are the clients? Us, basically. And if the dealers are net short, then everybody else must be net long, and the dealers are decreasing their net short position. So everybody else is decreasing their net long position, but not completely, right? We're not back to zero. The broader market society isn't negative Microsoft yet. And in the last 3 days, they have stopped getting out of it. They didn't pile back in, from what we can tell, but they didn't continue to exit out of their position. It looked like they were going to fade out of it, to de-risk in front of earnings, which made perfect sense. And it's why I was focused on getting that short. We saw them getting out. We had earnings coming up. We have this massive run that it had, and every expectation to think that they would de-risk into earnings, which is what they had started to do, and then they stopped. So I don't know. Maybe that short will still work. Maybe. But right now it's not working. The spread is still out of the money, so there's no reason to do anything with it yet. Just let it mature and bake in the oven. But this ain't cool. It got that breakout, nice little scoop pattern on the daily, and it's still doing what it does. Meh. It's a nice reversal pattern there. That is a textbook pattern, by the way. If you're looking for short-term option trade signals, and you can catch this one near the end of the day, that is a great trade signal to take long. You're looking for one of those alley oop plays, right? So you want to see a long wick drop down and that it rallies back up. And one of the conditions that I like to use is that it rallied back up through the higher than mid. So you can snap a quadrant line on there. And if on the day it's above the midpoint and it's run up like this, you can look to take a trade on it at the end of the day. If you don't get it that day, it's not too big of a deal. You can get it the next day. You see how the wick faded down? We got that drop down. It tried to close the gap, is what it was trying to do. And it didn't manage to do that, but it tried. So you can try to catch it on that wick. You still want to get the call when price is falling if you can. But this is a gap up on a daily. It's not as good as a gap up on a weekly, but when you can add that to it's a TRB, it's a reversal off the low flip, and it's a gap up with a gap that didn't close, that's a nice run and it owes you back to the top at least. It's a really nice pattern. I don't know that you can search for it necessarily unless you could teach Thinkorswim this pattern, which, I mean, you can teach it some patterns, but if you visually spot that setup, that's a really good trade setup. It's short term, it only owes you to the top, so you use next Friday's options expiry and you just, get what you can get out of it. At the bare minimum, you can do like a put credit spread underneath it. Something like a 500 495 or a 505 495, something like that. Because even 505 was in the previous day's trading range. It would have been a fair shot. That'll help you pay for the call since the calls are kind of pricey. But that is a really good pattern. And it's even better if you find it on a weekly. Much better. Here's the same version back here. Can't go too far over it. Hides it with the whale target. If the reversal, it doesn't have the big wick down below, but get the rally up, close higher than where it opened, which is why it's green, and higher than the 50%. And then look at that massive gap the next day. If you had been able to catch that on the low day, great. But if not, the next day, try to catch it when it closed what most analysts would say is a gap close. I don't. But analysts will use the high and the low of a candle bar and they'll say that's the gap that needs closed. So I won't, but say it bounces off the previous day's range and starts to run back up. There's your long on the day. And you just try to get what you can get out of it. But those are more shorter term. Use the current week's expiration. You could use next week if you want to, but you want to use shorter if you can. And you're just looking to get back to the top of the range. So if it gets there in the same day, get out of it. You're not even trying to get more. I mean, this gave more, but you wouldn't have wanted to try that. You won't know that you're going to get more. It is a nice pattern. TRBs, I like them. I've even made little stickers and gifts and that sort of stuff over this type of pattern. Now, mine in what I just posted in the chat doesn't have the gap in it, but still, it's a nice pattern. I made that. So we're going to talk about pivot points. And I did share a book, The Secret to Pivot Point, or the Pivot Point Trader's Secret, or some. It's a good book. Yeah, that's the one. Yeah, something like that. It is a good book. Um, if you guys have never tried this before, you can just go to Google because these levels have been around forever. It misinterpreted. I ask for stock symbols so much that when I misspelled Google, it was like, yeah, here's Goog. No, I don't want Goog. You can get the pivot points for the pivot point calculations right off of Google. And I made my own before I realized that Thinkorswim actually had this. Because if you go to Thinkorswim and you type in floor pivots, you don't find anything. So when I was new and I was like, oh, well, Thinkorswim doesn't have it, I'm going to make my own. I was so proud. I went in there and coded it and spent quite a while doing that because I didn't know how to code very much back then and we didn't have AI to help us. You can take these calculations, the high plus the low plus the close, because you have to get all three, and then divide by 3. Why are you dividing by 3? Because you had 3 pieces of information. You can change that, by the way, and use open, high, low, close, and then just divide by 4 instead. I also know people who averaged the high, low, close over the last, say, 5 days, and then they divided it, right? Or they took this and then they calculated it over the last 5 days, averaged it, and calculated it. So, if when you think about all the different ways you can manipulate this formula and do, your own stuff with it, your ideas just begin to expand. And that's what John Person did with person pivots. We'll get there in a little bit. So that gives you what we often call the floor pivot or just the pivot, and that's the pivot point that you see me talk about, the daily pivot and the weekly pivot, because it's high low close. That can be any candle, right? We can use a weekly high low close, the daily. You can even do 5-minute pivot points if you wanted to, or 15-minute, 1 hour pivots. Day traders can make these relevant to whatever it is that they're trading. But the most common is the daily. And then you've got your SNR levels. So, first resistance, first support, second support, on and on. It kind of just goes from there. And I got that right off of Google. So once we know that we can get this information from Google, well, what else can we get? We know that there's something called Camarilla points. And then there's John Persons pivots. There's Woody's pivots. There's just so many different ones out there. And knowing just those, we can, ask AI, hey, I found these pivot points. What others are out there that I don't know about? And it'll give you a whole list of even more that we didn't even know existed. Right. That formula that it gives you, by the way, rather than using open, high, low, close, you can use anything that you want, right? You can use 3 different moving averages. Um, Person made he made a moving average from pivot points. I like that one, right? So you can do a lot with these things. But the reason I point this formula out is because when newer traders first come across these pivot points, they kind of seem a little bit like magic, how often they work and how strong they are and how we see price respond around them. But at the end of the day, these pivot points are blind. They don't know anything, right? They can't see the news. They don't know anything about the trading flow that's coming in today. They are using yesterday's trading data and they're completely ignorant. So, you know, if today was FOMC or a big headline day or we had a bad auction or whatever it was that was driving price mad, these lines have no idea and they're not going to adjust to whatever's happening today. What I just brought up is Thinkorswim's SVE, which is its version of the floor pivots with the SNRs. They do still work. And there's more calculations that can be added to this. This is the default calculation. So now we want to talk about pivot channels. and its calculation, which is again nothing but math. So in the mornings, I show that chart that has the channels around it, and these are often called CPRs. The one that I'm showing you is Thinkorswim's floor pivots. So if you go looking for it and you're like, Thinkorswim doesn't have floor pivots, it does. They're just called SVE pivots. I don't know why. Yep, I believe so. Yeah. But they've also got Woody's pivots, SVE person's pivots. They got Camarilla pivots. They've got the other one that I always forget. They've got 7 or 8 different pivot programs in Thinkorswim. And of course, I added my own along the way too. The thing is, if you are looking for them, you can run either one. And I believe I had an issue with pivot points, the original pivot points one, at some point where I was like, no, I'm not using that anymore. I believe my issue was if you swapped to a weekly one, that it didn't work correctly. Right? I'll go back in there. Quote pivot point is the one with the very fat lines. And you can see how it's not matching the other purple line. They should be, right? They're both pivot points. I haven't adjusted either one. And I'm going to open the fat one up and I'm going to change it from day to week. And as you can see, it moved it lower, but it didn't stretch the line out for the whole week as it should if I wanted a weekly pivot shown on my intraday chart. So now we'll take the skinny one and change it to a week. And this one now is way down here and it's stretched for the whole week. So I had a issue when it comes to just the quote pivot point one. If you're going to be on Thinkorswim and you don't want to use, a custom indicator, leave the pivot point one alone and use the SVE. It is your better choice. And you can load it twice, right? So that way you have your SVE pivot daily and you have your SVE pivot weekly. And I always just leave it on purple, just, it's like default for me or whatever. And we reached the R2 for the week. We're talking about R1 and R2 and R3. We hit R2 and we stopped. That's where we stopped in the overnight on SPY. Pretty neat. Pretty neat. On the ES, we hit it this afternoon. It just ran right through it, like it wasn't even there. So SVE, and then I use something a little bit different, right? I use those channels. So I got the CPR channels. CPR is central pivot range. And the central pivot is the purple line, right? It's the pivot line that we've all been talking about. And then we have the range around it or a channel. So if we go back and look, by now it should have that formula. This is the formula to calculate the central pivot range. Down, should be down here. There it is. That'll give you your top and bottom central pivot. So the point is, A, don't ever buy a pivot indicator, right? Never, never, never buy a pivot indicator. You can just hit Google and find the formula if worse comes to worse. And then, you can work it out on your own. A lot of places, by the way, will list the pivot point levels even in its dollar amount. Like they'll just say today's SPY, top pivot is this number, bottom pivot is that number. They'll just give it to you in that format. So don't don't ever buy a pivot indicator. And if you go to places like TradingView, They've got a lot of custom indicators on there, including central pivots, which is kind of nice, right? Because we don't want to have to go calculate all that stuff out. So I'm writing the word central pivots, but if I had typed in CPR, you can see CPR works too, and you could just get it that way. Here's central pivot range with 1.7 thousand people, and another one with the daily, weekly, monthly levels with 2.6 thousand. You would want one of those, I'm sure. So John Person, who used to do a lot of streaming with Thinkorswim back in the day, he has a couple of indicators on Thinkorswim. Just type in the word person, and you get three indicators: person's pivots, person's pivots moving average, and then I can't remember the name of the last one. You can see the letters, of course, PPS, PMC, and then person's pivots. I'm going to hide mine again just so we can see his. So this moving average is derived by daily pivot point levels, and the or by the pivot points calculation. The same with this lower indicator, it's also based on pivot points. And I know back in the day, I went to YouTube and I hunted around for videos that he made on these three indicators. And when they first came to Thinkorswim, I think he was selling them somewhere and they were like bringing them over here too. And so his promotion was, you can buy it from me to use on Sierra charts or wherever it was. I don't remember. Or you could join up Thinkorswim and then you could use his indicators for free. None of that matters, right? In the grand scheme of things, it's just interesting how times have changed. But he explained what these indicators are doing. That's the best part of the video. Why he made them, what they're doing, and how you can use them as a trader. He put it right in the video in the public on YouTube for free. So you didn't have to buy any courses, buy a book, anything like that. You could just watch the video and put these three indicators together as a team to get a really good idea about how to trade today's trading range or the week, right? Because he showed how to use some of this for swing trading. You can see how there's lines missing. Hopefully, you kind of recognize that, hey, we don't have all the lines. There's one red and one green, so that's your SNR. And then there's today's floor pivot. And if you notice, the SNRs, they're not equal. There's a much bigger gap up here than this little gap down here. Same thing here and here. Why is that? Little gap here, big gap here. It's giving you the directional bias of the projected market move. After this big run up on this day, it extended the red line higher and brought up the green line lower because it's expecting, well, we ran up, maybe we'll pull back and then we'll make another run up. It's just like I was talking about in the morning briefing. A lot of these tools, dynamically speaking, are just trying to read price for you. So after we get a big move, we expect to pull back and then another big move, and then we expect to pull back and another big move. Yeah, it's what we do. So it's what the indicator is doing. And for those who can't read it themselves, it's trying to help you and read it for you, give you that direction. The problem is traders read that and they think, "Oh, we're going higher." No, that's not what it said. It's more likely that we go higher than lower. Or if we do go lower, it's likely not going to break this level. As long as whatever we had back here is still in play, then we should, continue to go higher. But this thing isn't making us go higher. It's not making us go lower. It's not going to really act as a support and resistance because it's not really designed to do that. It's just measuring if we got a pullback, how far should that pullback go before it's not really a pullback anymore and it's actually just a change in market direction. Floor pivots. So they're pretty handy, pretty neat, and they use the same type of logic that I use as a pivot point trader because I do use high, low, close. Those levels are really important to me. And I like having a tool that uses my tools. That just it really works well in my head, right? It's got nice symmetry. That way, it's not something out of left field that I have no idea what the heck it's doing because I don't like tools that I don't know what it's doing. Those two lines, by the way, we just kind of get rid of all this other stuff. They do work for swing trades, mostly just staying in the trade and or reducing risk. But yeah, they do work pretty good. I remember at one point I was trying to define some sort of MACD style way to read these, and you know maybe the other person's indicator is actually deriving that itself. It's been so long. Let's see if we can spot it. That's a crossover. This is where it's really wide. There's a crossover. So no, it's not doing it, but it didn't hurt to check because if he had already made one, then we don't need to, right? But that's not what he made. So we could certainly do that. We could make a MACD based on those two moving averages rather than what a MACD normally calculates, which is a 1226 regular moving average. MACDs are a really good indicator, by the way. I don't know how many of you guys have really done any work with MACD, but these are a really handy indicator. It's got a lot of features in it, like divergence and stuff. But it will do what the stochastics does, which is get tangled up, right? Like that. And that's really good. I know people don't like it, but I do. It's like having your foot shove the gas pedal all the way to the floor. You're trying to go as fast as that vehicle can go. When you see a market like this and it's above the zero line or below the zero line and it's just tangled up together like that, then they're putting all the effort they can put into it. It doesn't mean it's going as fast as it can go, because just like with your car, you can be doing 30 miles an hour and shove your foot down on the gas. You're not instantly going as fast as you could go, but you're now trying to go as fast as you could go. There's the difference, right? Is that you're really putting it out, trying to get there. So I like indicators like the MACD and the stochastics that will tangle like this. You can stay in your position as long as it continues to do that. Once it breaks down or maybe breaks out, then reevaluate. So with the MACD, if it's reading two moving averages, then any moving averages you happen to ever come across, you could adapt this to read those. Right. So that'd be an interesting project to work on. Is when did we get crossovers? How far apart are those two moving averages from each other? And then how far away is price from those moving averages? Because that's what a regular MACD is reading. It kind of makes sense to me, right? We were talking about short term indicators today, like the 3 and the 10. And if you've got a reason to focus on something like a 3 and a 10, then it makes perfect sense to change your MACD to whatever you're focused on. So here's a 3 and a 10. More violent, definitely, right? MACD is a lot more violent now. But you would want to focus on the extremes. You wouldn't want to read this on a day to day basis. Just are we above and below zero? And then are we pointed higher or pointed lower? And where's our extremes? It's sloppy though, huh? See if we can smooth it out. Let's give it a 1 month look back. Yeah. Yeah, I think that cleaned it up quite a bit. I would turn the MACD off and use the average of the MACD. Now you're cooking, right? And then maybe turn off that trash. Yeah, these are really good to tell you how we got to where we are. That's what indicators are designed for. The problem is a lot of people who approach trading think that this is going to tell us what's going to happen next. And it is not going to tell you what's going to happen next. It was never designed to. So when we look at this, let's just back up to here. We had a really strong turn off of a very deep level. And angle wise, if we're thinking, like where 90° is, if we think about 0 and 90, this is a very sharp angle higher. So it was steep, it was aggressive. And one of the things that that would tell us is, hey, we need to kind of give up on some shorts here. Maybe not exit at the time, right? Because this is back up a little bit more. So you know, if it was still back here and just starting that J hook, you wouldn't know to get out of your shorts completely, right? You wouldn't know to go long, but you could certainly start tightening up and reducing your short exposure because this is starting to curl over just like it did back here. And back there, all we did is stalled out on the drop and then we dropped some more. So we could take that same signal and say, hey, maybe we need to get out of some of our shorts here. But this isn't telling us, are we going to break out? Are we going to break down? Are we going higher? Are we going lower? It's not telling us anything except, hey, that drop down has stalled and we're losing momentum. Then it curled over and started to go even higher still, and price got to a key level. It broke that. And we can see this and say, wow, we've got a lot of upward momentum here. It's still not telling us where we're going, how far we're going to go, if we're going to turn, because it's not designed to. But it is telling us that all of that short momentum is gone and that we are now getting a long momentum. And that so far we're seeing nothing that is slowing this down. So we're not getting any contrarian signals. We're not pausing, curling over, stalling out, going flat, nothing. It's just pointing straight up and it's still going. And it didn't match price. Price stopped. It stalled. It went sideways. This didn't. It just kept going straight up. So indicators like this help you understand how we got to where we are and to read the landscape. But you still have to try to figure out, are we going to go higher, lower? What should I do, based on price action? And that's just lost on a lot of people. They expect the indicator to give them the answer of what's next and where are we going. Ichimoku is really fun, but even that thing, you know, no. Yeah, I used to dog on RSI all the time because there was, a cult following with this thing for a long time. And if you poo-pooed on it in any way, they would just get really salty. And I just loved digging that wound. But we all got to have something to mock. It does help if you want to be a swing trader to have a consistent analysis platform, right? By platform, I don't necessarily mean a broker like Thinkorswim. This three grid chart, as noisy and as wild as it may look to you, is very comfortable for me because I look at it all the time. This is my three grid setup for evaluating swing trades. I look at these same tools all the time, every day on anything that I want to trade. I always look at these things: moving average, Bollinger Band, stochastics. And sure, I'll swap Stoey out for a MACD, or I'll swap the Bollingers out for acceleration bands, but it would still be bands, some lower indicator, and moving averages, always. So you can adapt it. It's not, set in stone. And the reason that you should adopt something is because you want to approach technical analysis with consistency. And if you're bebopping around to, every week you're using a different indicator, you're not maintaining any consistency. Plus, the more you use an indicator, the more nuances you learn about it, right? Every indicator is finicky and it has its little things that make it good and that make it bad. And what I think might be a really poor feature, you might think is a really awesome feature, and vice versa. So you can't really ask somebody else, hey, is the MACD, the right thing? Maybe. Maybe you want to use the stochastics instead. I don't know. You should give it a try and see which one you like better. So put together something. Take a little bit of time, and you're not stuck with it forever, right? You're not marrying the thing. Take a little bit of time, use it for a couple of weeks or a couple of months, and at the end of it, you'll have a really informed decision about what you like and what you don't like. Great. At that time, look at what you don't like and make subtle changes, very small changes, and then use it for a while and see if you like it. And then make another small, subtle change. The reason you want to make one small, subtle change is if you change too many features all at once, then you'll lose the work that you've been doing, and your outcomes are now split up between, okay, well, something happened to my trades. Was it because of this thing that I changed, or that thing that I changed, or this thing that I changed? I don't know. I changed too much and now I don't know what caused what. So just make small, subtle changes. Get familiar with reading them, and if you can, try to write your analysis out. And you can say it, right? You don't sit there literally writing it down. Turn on one of those auto recorders and speak your analysis and listen to it later if that's what it takes. Throw it into AI and it'll write it down for you. That way it just takes your words, puts it onto paper, so to speak, and then you have it. Try to find normalized language that suits you on where you think resistance is or support is and what should happen when we get there. Because a lot of people just don't know how to perform technical analysis. Or I'll ask them when they'll say, hey, I was right. Look, my trade got to XYZ. And I'll say, yeah, why did you think it was going to go there? You were right. You won. Cheers. What did you do? Why did you think it was going there? Oh, I wish I could tell you. It was just like this gut feeling. I was just looking at the charts and I just kind of knew it was going to go there. Yeah, well, that sucks. Good luck repeating that. Maybe you have a bad day next week, and then you can't redo it. So try to, you know, put it into writing and get used to articulating your work in words, because it will help you identify where you're doing something wrong. Don't feel bad. We all do something wrong, right? And we can all find ways to improve. We have a Bollinger Band breakout on JOBY on the weekly, and it broke back inside the Bollingers this week and then ran right back out again. Looks like it's going to be closing at the high of the week, maybe at the high of the day if we can run back up here again today. It's got this little mini scoop pattern on the daily. I like it. Of course, I'm already in it. It doesn't matter that I like it. Moving averages make for really great analysis. Um, I turned an indicator into a little bit of a toolbox once, so that the um, the indicator itself was performing analysis, and then it would write those words on the chart as we went. So let me see if I have words turned off. Hide the moving averages. No, no, no. Show analysis. Yes. It should be showing more analysis than this. Let's jump around to something else. So it's telling you how far away from the mean we are in percent basis. It's telling you where support is or where support should be. Not really adding in. This might be one of the younger versions. Yeah, I think so. I had come across um, a lot of moving average material over the years, and it was using just plain English words, much like how you use the MACD with plain English words to uh, explain what was going on with price and what should happen next. So the 410, the surge, you can put that into English. And then, of course, you've got strength, momentum, trend, all of those. So if we read it, we've got bullish surge with bullish momentum in a bullish trend with bullish strength. Of course, you could replace strength with health. We're healthy above the 200, the broad market healthy. And so it just starts forming a paragraph of descriptions, all from moving average. If we had a bullish surge in a bearish trend, then that would be a completely different surge, right? We'd have to approach it differently. Or if we had bullish momentum and then we started to see bearish surge, right? So, you start putting all the pieces together. Pretty helpful from a standpoint of, just a simple moving average. And by simple, I don't mean like using SMAs. I mean, these are just nothing more than a moving average. It's as easy as that. We got a really nice fork pattern. It's been maintaining above the 20 since its last earnings, which means it's really strong. And that momentum is still here because it continues to daily close above the 10. That's a really strong stock, and it was all started on this earnings gap. So then when we look at it on weekly, it has maintained above that 4 period weekly moving average since earnings, and we've fanned out all of the weekly, and we're still riding above that 10-week, which we have dragged sharply to the upside. This thing is still crazy bullish. The short that I was looking for that I had called out was the idea that we could get, like a 6-week slowdown, just a pullback, because at some point this thing's got to pull back, right? I thought we could get something like that up here and then maybe move on. But so far that ain't panning out. Not yet. I ain't giving up on it. It's got time. And if you are dealing with a lot of choppy things, like say these quantum names, they're kind of hard to read. The charts are young. There's not a lot of history to them. They're really violent. As odd as it sounds, take it out to a higher time frame. I know I don't want to trade a monthly any more than you do, or a quarterly or even a yearly chart. But there's times where going to those charts provides a lot of insight. It gives you that missing piece of information, or it at least cleans the chart up a little bit and helps you focus more on the things that maybe are the most important at the moment. And as you can see, I just drew my quadrant lines, and the half is way up here, right? Because I've got Linreg, or not Linreg, but I've got a log chart here because it is a monthly. So we can turn that off, and sometimes you need to. Now the half is more normalized. The other lines, it didn't matter. Right? We're just going sideways. So we can adjust the charts to help us visualize what it is that we're working on. There's no wrong way to go. And at the end of the day, none of them should tell you what we're going to do next because that's not its job. It just helps you understand what we have, and then you have to make a decision about how much are you willing to risk. This is why a lot of times it's easier to go in a sell to open trade because we can say something like, I don't I don't know how far we're going to fall, but I'm pretty comfortable with the idea that we're not going to close above say 20 this expiration. Cool. Sell some call credit spreads, right? $20. That's a lot easier sometimes than saying I think we're going to go to $15 or $13. I don't know if we're going to go to $13 between now and expiration, but I'm pretty comfortable that we're not going to get above $20 between now and expiration. Wow, 20 is way out here too. We could shorten that up quite a bit. Let's see what 1820 has to offer. I don't want to be that far out of my way. We're getting good money way out here. Got a dollar wide at 45 cents. Excuse me. We got a $2 wide at 45 cents. Not a dollar wide. That makes sense. We were getting 25% of the position out there, which still is pretty good. Let's build that again. 1820. That is 25%. So you're risking 75 to make 25%, basically. I don't like it. I'd rather get a lot closer. Risk less and make more. So here's $2 wide. Also, same. We don't want that. So 16, 18. Now we're getting somewhere. We lose our positioning, go any deeper. So 17, 19, or 1720. I don't like it. One of the things that you can do when it comes to credit spreads is build a spread at the money and see if they're offering you fair value right now. This is a 50-cent wide trade. They should offer me 25-cent credit, and they're not. Build the same trade on the other side, 50 cents wide, they're offering you 27 cents. They would be very happy with you if you sold some puts. It's what they want. It's not what I want. So you can see how they're leaning towards, oh, you should totally buy some puts, or you should totally sell some puts. Yeah. Come in here and sell some. And they're offering you just a little bit of premium to make it worth your while. They're enticing you, but that's not a fair trade either, right? Why are they willing to take the handicap? We know that having a call credit spread right now is the better choice, but we have to take the handicap. I don't want to take the handicap. Oh, hey, Marziti, I was talking to somebody today that is right up your alley, man. They're really hung up on sector rotation or the lack thereof right now. And they were mainly just eloquently complaining about the fact that there is no clear sector rotation at the moment, right? I mean, there really isn't. This is like a rising tide scenario where we're getting all of the boats rising, right? But we've had this situation before. And when I brought up the last time that we had a situation like this, it really kind of helped him out a little bit. So, how are you doing with sector rotation right now? You having issues trying to find the got your hands full with the new project? Yeah. So the last time we had this sort of market backdrop, we ended up focusing on left for dead, small cap, short short float stocks. It was basically a flight from crowded trades, right? And that's what we were seeing the institutions do. We got to think about how institutions choose what they're going to trade next. And a lot of times they just rotate through the sectors, right? But it's capital allocation and where are they going? So if they're not allocating into the sectors, because we're not able to, spot that sort of movement. If you look at the sectors right now, I mean, they're all going, right? That's the rising tide scenario. Then we're left with, well, how are we supposed to spot their allocation tactics or what tactic are they using? And that led us back to the last time we had this sort of situations where it was small caps, right? There's ETFs that come in really good for that, like the IPO ETF. That's one of them, or something like FYC. It's small cap growth index, or SLYG. All of these that are on my list here is all a part of this. It's all growth versus value in small caps and small cap ETFs, CALs, CAF, IPO, XRT. All of those are really good to use for spotting this sort of market behavior that we're in, right? This dynamic, and you can open those ETFs, right? So the top 10 on CAF, for an example. Yeah, I really like stockcharts.com. I miss my account there, man. I really, really miss my account there. If you look at the ETF list, this would be a good place to focus when we do have a rotation that doesn't fit the normal model. And I can share the whole watch list really, but it's really those top ETFs that people want to focus on, right? You can open those ETFs up, by the way, and do what I did in the watch list, but there's the entire watch list. The top 10 names in IPO, I mean, they're not doing too bad today, but they're pretty ugly, all things considered. But these are the things that are getting attention. You know what I mean? Like, look at the flip in a lot of these, and just junk. It's just junk, but it's beat down, over traded junk. All right, so I mentioned a book last week. It's from John Person. I couldn't find my copy, but I found it online at some point, which is why I had a copy because I didn't buy it. Um, Candlesticks and pivot point trading triggers, setups for stock, forex, and futures, and it's written by John Person. Which, of course, I'm going to put that in the chat because you don't want to have to try to remember that. I know I have a copy somewhere. I can't find the darn thing. But it had really great examples in it, and I like those kind of books because it's how I do my own work. So let me just like bring up what I mean. Um, when I get a book, I rip it apart. So there's a really good book by Adam Grimes. It's called The Art and Science of Technical Analysis. And I really like that book because when I read it, I realized that that guy had wrote my entire trading strategy out, and I didn't read the book beforehand. I really wish I would have. It would have saved me a lot of work. But he had articulated everything that I had come up with on my own from doing all the hard work. I just found it in his book afterwards. Like, this is fantastic. I loved it. So what I did is I built a Discord because Discords are free. You can make one, right? I made a Discord. I took his book, this one, and chapter by chapter, I cut and pasted everything into this Discord. And as I did it, I read it. If I came across anything that was unique or different, or I wanted more information on, then I would take notes. I used to have a note channel in here. It's not here anymore. And then I would go to the web and I'd search for information on what I was missing. And I just worked my way all the way through. So when you find a pattern and you want to know more about it, right? Call timeout, read through it. That's one that even Al Brooks likes to trade. But a lot of traders share, the same patterns. They just have different names for it. So you can do the same thing. And in his book, he had a lot of good examples in it. That's why I'm bringing it up. He had real examples from the market, not just theory and concepts. He went and found examples and cropped it out and explained how it was an example and where you could use it, where you could find it. Discords are a fantastic learning center that you can build just about anything you can want, right? I've got Discords for cooking. I keep all my recipes on there. For gaming, for projects around the house. I've got Discords for everything. There's a website that I used to use a lot called Swing Trade Bot, and that website has trade strategies that the bot uses to scan for trades. And of course, you don't need an account to use it, but if you have an account, you can tweak the settings more. But they show exactly what the trade settings are, like what the scan settings are. So I copied all of them down and then built them into Thinkorswim. And those go to a book called Hit and Run Trading Part 2. So if you've read the book, then you go to the website. They've already got the scans from the book, and then you run the scans. So that's the book. Um, I know I had a copy, so I'm pretty sure you'll be able to find it online. But I do have a couple of subscriptions to like these book depository places to where it might cost you like $5 a month or $2 a month. It's not expensive, right? So maybe you might have to sign up for some kind of PDF depository to get it or something. But Repository, not depository. I'm curious. Let's just see if we can find. This whole China AI kicking off over the weekend, I think we could get some attention out of Bitcoin. It's 3 a.m. in Hong Kong. Yeah, Scribd is one of those places, by the way. If you don't have a Scribd account, really think about getting one. You get a lot of stuff from there. This is an old book. I wasn't sure I could even find it, but it's called the Swing Trader's Bible. It's old. It's like 1950, but it's old. If you're thinking who cares is too old, you'd be surprised. I've gotten some really good stuff out of books from like the guy that made the MACD, Gerald Appel. A lot of his books are old, but he had some really good stuff in there too. Hey, did you see that message in the moderator chat? The thing about the old books that you really want to watch for is if they start talking about options. If it's from earlier than say 2010, don't even waste your time, right? Because the options market has undergone some radical changes. And if they start talking about teeners and eighths, just go on, get a different book. It's because we used to run a 32 fraction on a lot of markets, right? We didn't even have penny prices. We had fractional prices back then. And it's not worth it, right? That book is too old. So never mind. I don't care if it's the Swing Traders Bible. I just can't do that. It's too old. But the reason I went and looked is because he was using the same um oh certain type of trading day logic that you can find in the Pivot Boss that we shared last week. That book, that Pivot Boss book, will explain those 6 types of trading days and how you can use floor pivots to define what today's type of trading should be: a range day, trend day. And then if we do break out, where are we going? And of course, if we stay range bound, is it really range or is it chop? Because that's what we would have to define if it's not going to be a breakout day. I never run Grok on this browser, so it's like I don't know you. Yeah, you do. Yeah, you know me. So I asked AI what the best swing trading book was from 2020 to 2025, which was also an award-winning publication. We'll see what it shows. I have no idea what kind of answer we're going to get. but it's the Grok 4, so it's not just spitting out an answer, it's actually thinking through what I said and trying to come up with an answer to the query. We'll let it cook, see what it comes up with. So, go back to these discords for a moment. I've put together discords over the years for all sorts of topics. This one's unusual trading activity. Different apps like Tradie Ticks, Whale Stream, black box stocks, just all kinds of places that provide unusual options activity. The logic that they've presented, different scanners that I found, places like the Big Short and their tools, um, whatever I could find on UOA material, which is great when you're just trying to really get more comfortable on unusual options activity, spotting it, scanning for it, trading against it, or profile charts. I spent a lot of time learning how to use profile charts, footprint charts, and volume profiles, TPO charts. So that one channel right there, the collection, I go and grab a bunch of videos that I know have information on that particular topic. I stick it in that Discord, and then I watch them one at a time, pausing the screen, capturing pictures, taking notes. This way, I'm not trying to multitask. I mention that because I used to watch videos. Well, watching is not really the word. I'd have a video on while I'd be sitting there screwing around with my charts, messing with scanners or settings, chatting in the Discord with other people. And I'm kind of halfway listening to the video, but I'm not really listening to the video. You know what I mean? I'm missing key pieces. So I started doing it that way. Bring in the video, make the video full size, and your only attention is on that video and what they're talking about. And then if pausing it, taking pictures, taking notes, and then digging deeper into the stuff that they talked about and the notes that were taken. And that entire Discord would cover that one particular topic, and then on to the next, and on to the next, and on to the next. As you can imagine, I've got a lot of Discords. Candle technical analysis. There's so many different ways to perform technical analysis, and there are key patterns that repeat more often than others, and different ways to use these different trades and run them contrarian if you like. It's a lot to learn, right? So I just found that Discords provide a central learning center that you can use to gather your information and then keep it organized and contained until you get there to work on it. And if you're thinking, oh, this is just so much stuff, where do I start? You start with whatever it is that you're most interested in, because it's a lot of work, right? If you know how it is, if somebody tells you to do something, you're just really not going to be that interested in doing it because it's something that somebody told you to do. But if it's something that you want to do, something that you're already interested in and that you're excited about, oh, you'll do it. You'll do that and then some. So just focus on whatever it is that you already have interest in. It will lead to the same place, you having more information about trading. This is my range and trend Discord, which is 100% focused on what today's price is going to do. The entire Discord is nothing more than analyzing pre market behavior and after hours behavior last night to define and anticipate what today is going to do. And all of these Discords continue to grow, right? I find something new that really changes the game or changes my perspective on the game, then it gets a new channel, and I build it out and go from there. All right, top swing trade books. It's done. It's done thinking. So let's bring that back over here. Oh, I guess we didn't have any winners through that time frame. I'm gonna have to ask, when was the last winner? The closest winner in context is Victory in Stock Trading Strategies and Tactics of the 2020 U.S. Investing Champion Oliver Kell, published in 2021. Details the approaches of the author who won the 2020 U.S. Investing Championship with a remarkable 941% return. Oh, wow. The year of 2020. That's a hell of a 1 year return. Yeah, here's the name of the book and when it was published. I will put that in the chat. No, I mean, that's a fair question. My discords that I mentioned are not public. No, they're mine. You can make your own. If you're looking for a discord, for learning and growing and education, just go to the Bullish Bears, right? Hey, you're already here. Right on. And make your own. It said something here. I want to ask it another question because it said there are no swing trading books from this period. Those are the key words that have won major literary or business awards. It's not what I wanted. I just wanted you to get your little arrow out of the way, fool. Darn thing. I love it. They'll put a bubble in your way and then you can't see past it. So you click on the bubble to get it out of the way. And then, like, oh, did you want to buy something? No, I didn't want to buy anything. Go away. Not buying nothing. Here was some other books too that it named, step by step for beginners, including money management and chart patterns, fundamental technical analysis for momentum traders, covers stocks, options, forex, and crypto. There was another one, entering at market bottoms during corrections, including back tested data and tools. Yeah, okay. Focuses on high win rate strategy with a 17.5% annual return, 10-day holds. Yeah, I always be skeptical of those quote high win rate strategies because it ain't about winning, guys. If you haven't heard that yet or you haven't learned that yet, it ain't about winning. It's how much do we make when we do win, and then how much do we have to risk to make that win? And when we do lose, and you will lose, how much are we losing on average? So that Oliver Kell book has a really high average rating by people who wanted to rate its book, 4.4 out of 5. These others didn't have any award at all, and it's still thinking about when was the last book that had an award and what was the book. And then of course it mentions John Carter's Mastering the Trade. That's a classic if you guys haven't read that one. This one's not swing specific, but I say it all the time and I really do mean it. You can't paper trade your way to success, right? I know that we started today on kind of a mixed bag between day trading and swing trading, but really for day traders, because I don't know anybody that's really tried to swing trade and succeeded in swing trading paper. Yeah, Austin, I don't know if you were here when we started when I covered it, but if you didn't, you can certainly catch the replay where I went through exactly where those pivots came from and how to get them, why they were developed, all of it. Yeah, no problem. It's I covered it first thing because I knew it's what it was on the topic list, right? The key to all of it is that they're not predictive. They're not going to anticipate where price goes next, and that it's all just a math formula. So I show where to get the formulas so that you realize, that there's no magic behind them and you can't use them to plan the next world war, that it's just math and that it will give you guidelines and then how to find the indicators. Because those lines and levels, as fantastic as they are, they're nothing more than math. They can't anticipate news, and if news is happening, they won't readjust. They are hard coded in based on high low close. So we just take high low close, add them together, divide by 3, we got a pivot point. If we wanted that on a weekly, then we would take weekly high low close, divide by 3, and now we got a weekly pivot. But one thing of relevance that's worth mentioning, because I don't think I went into enough detail here on this, take that pivot point strategy or any of the pivot point strategies. How do you trust it? Right? Like, I show it every day and I use it every day. But say you just got here and you hear me saying, these pivots are awesome. Why would you trust that? Right? You got to build some trust with it. So, how do you do that? Well, how I did it is I went back and I found an example of where price did something that I thought was something I want to repeat, that it hit an R1 or R2, S1, S2, and I wanted to see that in the future. I want to play that trade or use it in my analysis. Then I need to find examples of where it happened. So here, for an example, we ran hard all the way into S2 and then we stalled out, or R2, excuse me. We just stalled out at R2 and it tested it 3 times. I would take a very clear picture of this and it would go into my Discord as a day where we went to an R2 level, including what day that happened, so that I could also dig back on that day and try to find out why the heck did we run like that? It happened right near the open. We had an 8:30 newsprint that dumped us down onto the channel and then we ripped all the way to R2. What happened that morning? What happened that day? And what happened this afternoon to sell us off like this? Because the pattern by itself isn't going to give us all the information, right? But it'll get us started in the right direction. So for every pattern that I trade, I research it because I got to have trust that the darn thing's actually going to work. I need to be able to recognize it. I need to know that I am going to see it again in the future. And if I can't find it in the past, I'm not going to find it in the future. So that indicator, like the cumulative tick, I went back and studied that, found examples of where it turned, when it turned, why it turned. That's just one picture by itself. But these sorts of shapes are the kind of shapes that I look for. Tangled runners to the upside, crossovers, reversals, cross downs. I go hunting for any signal that I want to trade and find as many examples of that signal as I can find. And I make sure to capture what day it happened to make sure it doesn't line up with a tweet or some other headline that may have, knocked the page off. So my 111 that I like to trade, it's yesterday's 111. It's the one that pays most of the bills. This entire file has nothing but 111s in it. Go back, find the setup, mark the date, of course, mark out the patterns. This trade is my best trade. It's another one. And it just goes on and on. It's another one. Measuring yesterday's high, yesterday's low, expecting price to have 111 reversals and or 1236 reversals. And we got it on both sides that day. That was March 3rd of this year. Here's an intraday version of that same day, I believe. No, it's November 4, different day. November 4, different day, just two different pictures of it. Right? That's the two bar. It's kind of a before and after. And that's the same day, by the way, after it ran all the way back up. And now that we're zoomed out again, you can see yesterday's high and yesterday's low. That's the basis for the drawing. That's the 111 that we flipped off of November 4th of last year. Here's another one, double top intraday off the 111 from the previous day. The idea is if I tell you about a pivot point or a drawing or a tool or an indicator, so what, right? You're like, I don't know you, dude. You told me it's great. Yeah, so what? But you got to get trust, right? And that trust is only going to come from finding it, learning it, evaluating it, studying it, and turning it into words that mean the most to you. So you're going to want to take anything that you study, pivot points, moving averages, indicators, whatever it happens to be, and study it. Me, I use pictures. I find that is what works best. Maybe you're going to need videos, or maybe you're going to need a lot of books. Whatever it is that gets you to trust these pivot points and to understand where the heck did these lines come from and how can we use them. So, in the book that I shared the other day, in that book, it talked about R1 to S2. It covers that. So, you know, that's there. And then how did these lines get calculated? I already talked about that at the start of the video. And how it picks the direction. I covered that today too. This one's a little more subtle, but there's one called Persons. His is not so subtle because his hides all the lines except for the two most relevant ones. So that now there's only one red, there's only one green, and you can see it's saying go long, not short. This one, green is closer, red is farther away. Go long, not short, right? So it picks the direction. Same thing here. Go long, not short. If it's the other way around, like this day, it was actually saying go short, not long. Because green is off the screen. It's like down there somewhere. And red is a lot closer. And still, it's just math, right? So the video will be out probably 10 minutes after I end the stream, and you're going to want the first 20 minutes of the stream or so. And then I'll cover how did these lines get calculated? What indicator will draw them for me? Does it have to be a custom indicator? And you'll be good to go. Then you're just going to want to spend 3 to 6 months grabbing those examples, studying them, getting new ones as they show up, and try to apply the examples to the thing that you trade. I mentioned that because I was showing someone this technique and they trade stock and they were giving me examples from Bitcoin. And I said, why are you taking examples from Bitcoin? And they said, well, I couldn't find what I was looking for on the market I wanted to trade, so I went to a different market. I get the logic, it makes sense, except you have to learn to trust that the market that you want to trade is going to behave the way you think it's going to trade. So find the examples on the market you want to trade, because if you can't find them, that means you're looking for a pattern on a market that ain't going to show up. Well, that's worthless, right? I found a strategy when I was new that had a 99% win rate. Like, damn, that's a really high win rate. That's an amazing candle pattern. I want to learn that one. And I spent a long time learning it just to find out that it's so rare that it might as well not exist at all. Well, that's worthless, right? If it's never going to show up, it doesn't matter that it's a 99% win rate trade pattern. I'm never going to find it. So that's worthless. If you can't find it on the market that you want to trade, then that's a really good hint not to try to hunt for that pattern in the future because it hasn't happened on the past, at least not in the time frame that you were able to use. What I mean by that is I'm on Thinkorswim. I'm on a 5-minute chart. I can go back, say 90 days on a 5 minute. It will let me do that. But if I try to go back a full year, now it says, nope, you can't be on a 1 minute chart with a 1 year look back. You just can't do it. Try something shorter. Yeah. Here's half a year, right? 180 days, 5 minutes. It'll do that. I just can't go any higher than 180 days or it'll knock me off of my 5 minute time frame. So if I searched back 180 days on this 5 minute chart looking for a particular pattern on the ES and I can't find it, it's probably a pretty good bet that it ain't going to show up in the next 180 days either. So I don't want to need to worry about that pattern. I'm going to move on and look for a different pattern. We get these sideways days and we get range days, which are two different things. And then we get those big reversal days, and then days where we run really big and we don't reverse. So, those are the 6 types of trading days that pivot points can help you better analyze, understand, and anticipate. Having said that, you're going to want to go back and find those sideways days and then start your research. Was that a short week, like 4th of July holiday weekend? Was it, around Christmas time or something? Um, was it a short day on that short week? Did the market close at 1 o'clock that day? Those are really important questions that you're going to want to answer. Then, based on what day is it, how close was FOMC, right? Was FOMC that week or the week before or the week after? Because price will do silly things on an FOMC week or a QRA week, which we both have next week. Was it a gap up? Did that have anything to do with it? You want to evaluate what you have based on what you found. Take pictures of it, annotate it in your journal, and then find more examples of that same kind of sideways day. I stopped where I was because I found this sideways day. And it's not that day necessarily that got my attention, it was the day before it. A lot of times, after we have one of those really good run days, which is what we had the day before, the next day we just flatten out and we do nothing, which is exactly what happened. I found that along the way, right? Just studying price action. Is it always true? Oh, no. We can run all day yesterday and then open up and run all day again today, or turn around and give it all back, right? There's no guarantee. But it's one of the first things that come into my mind when we have a rally day is what's tomorrow going to be like? And I start looking to see if it's going to be one of those sideways days or not. Because, well, it happens often enough, you know? Absolutely. In fact, we have a little bit of time left to see if we can catch one. So I did mention in the live stream this morning putting on an iron condor or perhaps a butterfly or maybe even a short vertical or something. One of the default things that I like to use in this scenario is called the weekly expected move. It's this weekly EM indicator. and it is custom, and I've shared it everywhere, but it doesn't hurt to share it again. So this is just weekly EM. EM stands for expected move, and we can see next week's projection today. Now, we can't build options positions on a 39-cent position, right? We all these need to be on maybe 50 cent or on a round dollar. And more often than not lately, when you go into SPY, it doesn't have 50-cent options a lot of times. It only has $1. So then we have to pick, are we going to round down to 646 or do we round up to 647? Since it's closer to 646, I'd say round that one down, round that one down, and round that one down. But you're going to want to look every week, right? If this had said 628.79, I probably would have rolled that up, to 629. But 39 cents is closer to zero, so I'm going to round it down. Rounding it down, that means we can put a butterfly up here at this 646 and a butterfly down here, and even one right on the middle if we want to, right? You can um, try to catch one on Friday's close. Those are the butterfly locations. The iron condor would be putting on the call credit spread up here and the put credit spread down here, and that builds our iron condor. And this is the range that we need to stay within. The reason I said I wanted to hunt for one, because I wasn't quite sure I wanted one, is that these are pure speculation. If we're wrong, they're going to lose and we can't save them. A lot of options trades, you can save them. They start to go wrong and you fix them. You're not going to be able to fix these. These are so far out of whack that, once you put them on, they're just poof, gone with the wind. And that matters. I won't put on, say, $1,000 smoke trade. You know what I mean? Like, I'm not willing to risk that kind of capital. But if I can find something kind of cheap, I'm down for that. I risk a couple pennies, couple dollars. Why not? So to me, shopping around means that I'm actually able to find one that fits the price that I'm willing to risk. Otherwise, if we didn't have that criteria, we could bring in other criteria, risk reward metrics, those sort of things. We could bring in like what Tasty Trade uses for collecting X amount of money versus the delta you're using, blah, blah, blah. So I got SPY. It says 645.9. That's not exactly the number we saw out there, but 646. So 646 on the upside. That is going to be a 1 penny wide, not 1 penny wide, $1 wide butterfly for a penny. What do you even have to work the order just to get it? So we don't want to feel that, right? If it's that cheap, bump it. So let's take that to 4, take that to 8. Now we're $2 wide, and now it's just 1 penny for a $2 wide butterfly on Monday for that line. I'm cool with that. You buy that for $1, and then you load another one. So if you're on Thinkorswim, you can just copy and paste this right into your Thinkorswim, and it will put that trade on your screen for you. You can paste right there. So I'm going to just change this to anything, doesn't matter. And if I hit that, hey, it's back again. So that would be Monday. We can do one for Tuesday, Wednesday, Thursday, Friday. And for a lot of people, they're just going to look at Friday, right? So there's Monday, Tuesday, Wednesday, Thursday. Here's Friday. They don't have the 44 probably, or maybe the 6. Let's see what's wrong with this. One of those days is missing. The 8 is missing. Okay. I mean, we can back it up one anyways. So we'll put that at 5 and that at 7. They got a $1 wide butterfly for Friday using these strikes, or we have to go $4 wide, set this to 50, and set that to 42. It's still a dollar wide. Man, that's $4 for a penny. I like that. Let's go bigger. Go bigger, go home. So we'll try round number at $6 wide. So we need 50. Oh, we don't have a 52. We got a 55. So what is that? $9? So we got to go 9 the other way. That'd be 37. You know, it would help if I unlocked it. Dang it, it was locked the whole time. Back to 50. That's $4. So we need 42. I bet it wasn't a penny. It was 58 cents. I don't want to spend 58 cents on that butterfly, right? So we have to wait until Monday to see if they get the 648 strike, which is what we're missing. 648 and 649. We don't have those yet. Otherwise, we shift down to like 645 and then we put on a 647, 645, 643, which really isn't a bad idea, even though that's lower than the expected move model by a point. At $16, 15. So that's shopping around, right? Find one that suits your price. How much are you, really willing to risk? Well, that's a bit of a tongue twister. And then line it up with these levels. Put your butterfly as close as you can to those levels. And you got every day next week to do it. But what I would focus on would be Monday and Tuesday because Wednesday is FOMC and that's likely where the market's going to start to go. And Wednesday is also the second part of QRA. We're going to get QRA on Monday and we're going to get the other part on Wednesday. And I don't think that our quote sideways week is even going to fit into next week, right? So I would get them today if you can. That way, they, especially if you're selling to open something like the Iron Condor, let it decay over the weekend and then on Monday, just get the crush from the weekend because they will lose time value over the weekend. I have a little bit of a concern today, elevated that concern even more. Um, most of the time, we look at an FOMC week as a situation where we expect the market to go sideways those 2 days, right? I call them hurry up and wait weeks. And in these hurry up and wait weeks, we usually cook sideways Monday and Tuesday, and then we get into it on Wednesday and we take off and go. But all week, we've been running, just grinding into new highs. Even yesterday, we were sideways. We still managed to get new highs yesterday, right? And then here we are again today, pushing at the high day, pushing at the high of the weekly expected move, no less. That's exactly what we hit and stopped right on the line, the weekly expected move. So, with that in mind, there are uh, examples in the past where we've had an FOMC week, and analysts just like me said, "Oh, it's an FOMC week. We're probably going to go sideways Monday and Tuesday, and then maybe expand on Wednesday, kind of like this FOMC week where we were sideways for 3 days." That's what we expect, and instead, what we end up with is one of those weeks where we just rip right off the bat from Monday into Tuesday, and we run even higher through Tuesday into Wednesday, and then things really get nasty, right? So while I'd like to say that Monday and Tuesday next week are very likely a hurry up and wait scenario, and that we're not going to have a big blowout move Monday and Tuesday, there is a historical precedent that says we could. We really could. So if you're shopping around for things to trade next week, a really far out of the money, and I'm talking, this trade will be 100% loss if you're wrong. So keep them small. $1, maybe 2 pennies at the most. So there's a 665 call on SPY that is trading for 2 pennies. You could probably work the order and try to get it filled for 1 penny. You could set that as good till canceled and just work the order at 1 penny. Don't pay more than that 1 penny. And the same thing for the put side. Yeah, if you go far enough out, there's a real skew right now, and so puts are just a lot more expensive. I don't know how far you'd have to go to find a put that's a penny, but I'm sure it's far out there. Oh yeah, it's really far out there. We start to get bag holders right about 620. It's actually a little closer than that. We start bag holding at around 625, and so it gets really sticky through 19 and 20. Man, all of these are trash. I would work the order at 625. I just set that at 1 penny, good till cancel, and leave it on even into next week, trying to see if that thing fills. Because the thing is, we could just rip Monday and Tuesday. I don't think we're going to, but we could. And for the iron condors, if you haven't heard me talk about this yet, this is an important piece to the weekly iron condors that has to be said. They're broken. We used to put weekly iron condors on every week. It was fantastic. They had a nice win rate. They made a lot of money. And when they were wrong, they were manageable, and it worked out really well. One of the criteria was that we would close at around 50% of their max profit. You sell to open an iron. And so you target percentages to close it. And we were making them at about $1 wide. So you build a dollar wide iron and you collect like 32 cents, 35 if you were lucky. And then you close those down at 50%. It doesn't sound like a lot of money, but they were consistent. You could size up, put 8 to 10 of them on, whatever. And even when they did lose, they were losing at around, say, 65 to 70 cents. So you were losing just your credit. You weren't taking like max losses on them. And they had a really high win rate, plus 80s, into the 90s on good streaks. But we can't put them on anymore. And we were putting them on every week. It didn't matter. FOMC, not FOMC, it didn't matter because they were just always good. This is the width of the current weekly expected move. And it doesn't seem like much, especially if you're new to trading. It's just a regular week. I'm going to take that week and I'm just going to copy it. There's the one that I just made. There's the one on the box. I'm going to leave it on the box. Back before COVID, when we used to do these every week. In fact, we were putting them on multiple times a week, right? Because they had Monday, Wednesday, and Friday expiry back in the day. Now we've got Monday, Tuesday, Wednesday, Thursday, and Friday expiry, but we didn't used to have that. So I'm going to take this back to before COVID. Still scrolling back. I need more days. 5 should have done it. I think I just needed to pull the chart, but whatever. There's COVID. So where'd my box go? There it is. So remember, the size of this box is our current week's expected move. And just randomly, I could pick any one of these days, but just randomly. I'm going to just set it down here. Zoom in. You see the weeks range that we have now compared to the weeks range that we used to have? Massive blowout range now compared to what it was. We travel so much more. So back in the day when we would put on one of these iron condors using Friday's close, we would be on Friday. Let's just scroll this to a Friday right there. We'd be like, well, it's Friday. We closed at 306. And next week's range is 310 and 302 and a half. Right. 30, let's just say 302. So that was our range. And we'd put a put credit spread there and a call credit spread there. And it's only $4 wide. $8 total, but $4 wide. It's a very small butterfly iron condor. And it fit our risk, right? It's fantastic. We could put like a 310, 311, that's $1. And then, 302, 301, that was $1. And there was our spread. Look at the size of this thing. Can't even see it. I have to zoom out. That is the size of our expected move right now. So when you go to build an iron condor and you're that far away from the current price, you don't get 32 to 35 cents. You get like 6, maybe 8. So you're going to risk $92 to make $8. Only we were closing at 50% profit. So you're not even going to get 8. You're going to get 4 if we can hit 50% profit and pay commissions out of that. And then, oh, well, what if you're wrong? If you're wrong, because these are so far out of the money, it's almost 100% loss. So you don't even get to manage it at a reasonable, respectable loss. No, it's like a max loss. So when you're wrong, you're really wrong and it hurts. So we don't do those anymore. They used to be fantastic. Now we actually can do them for a day, right? You would put one on for Monday, or when you're on Monday, you would put it on for Tuesday, and you'll get better credit than you will trying to run it for the whole week, or do a double diagonal or a double calendar, because those solve the problem of the width and the credit. You'll get a wider range than what we're actually working with, and you get way more credit, way more credit. And then you can put them on every week again, every single week, every day of the week, really, 1 week out. And then you have waves of double diagonals. It's pretty cool, really. You've never traded a double diagonal? You're missing out, man. Hold on. We're gonna put one on next week. I'm gonna put it on, and you can put it on. We'll risk $1, right? We're talking about a penny. We could risk a penny. We're gonna put one on just to put one on, just to watch it mature and grow. It doesn't matter if it wins or loses. It will be a really great exercise. These things have a lot to offer. Let's just go back to SPY because I know it'll be cheaper to do it on SPY. And I'm gonna just lay one out here. We can't put it on now, right? It's already too late. But we'll look at that 646, and um, that is what we would sell. In fact, I'm going to just right click on it and tell it that I want to buy a double diagonal, and it'll just do all the work. And now I just have to adjust things. So what did it do? Well, it gave us the call that I clicked on, that 646 negative, and then it went out another expiration, and it bought the next higher strike. So if it was a calendar, it would have bought a 646, but this is a diagonal, so it went diagonally up another one, and it went to 647. So now I'm short 646 and I'm long 647, and that's your basic diagonal. The reason these are double diagonals because I also did the put side at the same time, and that's what we have to adjust because we don't want in the money puts. We want to move that to 628. So we're going to go short 628, and we'll go long 627 for the next. Oh, shoot. I did the calls. I like Tasty Trades setup better. Double diagonal. There we go. 646, 628, 628 short put, and 627 long put. So the long trades on both of these are farther out on the 22nd, and the short trades on both of these is the August 15th expiry. If we were doing this next week, we would choose next Friday's expiration and then the Monday after that. But we're going to just, do this. You cannot, but that's actually a great question. So let's think this through for a minute. If I sell a 646 naked call, it kind of feels like I'm on the hook, right? Because I've got a naked call sitting here. That's crazy. And the margin required is like $175,000 or something like that. Let's see what the margin is on that naked call. Infinite. It's going to tell me I can't even do the trade. Hey, it's illegal. It's a naked call. You don't own stock, right? They're giving me all kinds of errors here. Really bad idea. But what would happen if we also own a call? Now I can buy the 646 because that's the one I sold, and that would be a calendar, or I can buy the 647. I'm going to buy the 647 so that we have a diagonal. That short call is covered by this long call. Because think about as an options trader, our rights and our obligations. If I sell a call, I am obligated to provide stock at that strike price. So if somebody exercises on me and they call away stock that I don't even have, I'm going to have to run out and buy 100 shares of stock and give it to them and probably not pay 646, right? I'm probably going to be in the money and I'll have to buy stock at like 650 or something, right? I'm forking out a lot of money that I don't have to buy 100 shares of stock and give it to them. Sounds really dangerous. But if I have a long call and they exercise against me on the short side, I can exercise on the long side. I can force someone to sell me their stock at 647 and then I can turn around and unload it to those guys at 646. Do I take a loss? Sure. A dollar between 647 and if you're a call buyer, you can exercise your right to call away their stock at 647 because you own a call at 647. It doesn't matter. You get to buy the stock. It doesn't matter what the stock price is. They have to sell you those shares at $647 a share. It you're missing it. You're missing it. It's 647. No matter what the stock price is at any time, no matter what the stock price is, they have to sell you that stock at that strike. That's the law. It doesn't matter what SPY's price is. You get So how are you hurt if you lost your stock at 646 and you got it at 647? Those are guaranteed fixed prices no matter what SPY does. That's your risk, $100. But you're not though. You're never going to be in the hole more than $100. This trade doesn't matter. This trade does not risk more than $100 max loss no matter what happens to the market, melt or explode. We could go to zero. You're never at risk of more than $100. The end. Ever. It's a bundled order. When I've gotten exercised on stock that I couldn't afford, like Google used to be thousands of dollars, right? And I got exercised on Google. You have a 24-hour time frame to resolve this trade. So in the overnight hours, they sent the email, which I didn't read because it was after hours. So the next day I come in and my account's like thousands in the hole, right? And I've got a margin sticker on the top of it. I'm like, what's wrong with my account? And I realize, oh, I'm upside down in Google because I have 1,000 or I was short 1,000. I don't remember, but I was out 100 shares, either short 100 or long 100, and I couldn't afford it no matter which way it was. So they're like, okay, you got, the rest of this trading day to resolve this trade. What do you want to do? And on Tasty, all you have to do is click the shares and then click the call that you're long, and it says close this order. Yep. And when you close it, it resolves the whole package, the whole thing. That takes care of the stock, it takes care of the call that you had, and that resolves because you didn't have another call, right? That was already gone. And it's just the spread. You pay your fees for the assignment or the exercise because you have to exercise against, your long. Somebody exercised against you on your short. So you have a $15, which is a 15 penny penalty or fine or fee or whatever. And then the spread differential. In this case, it's a $1 spread. That is your risk. That, because you don't have to go out and buy stock from the open public. You get to buy the stock at that strike price. I get it, and you should. You should always play devil's advocate, but the trade is defined by the strikes that we're trading, not by the stock price. But your broker won't see it because you've got both. So it won't look at just that naked call and say, "Hey, dude, you're in the whole 10,000. I'm going to exercise you." It won't. You've got a spread on like a vertical, and that's the only way it's going to read it until you no longer have a vertical. Then you don't have a short call anymore. Yep. Say it goes to 500. It goes to 500. Yeah. Play it out. Yep. And I get the stock at no. I get to close that call, exercise that call for the strike price that it is, 646. No matter what the stock price does at that strike. Yep. Yep. That's the sweet spot, right? Like no matter what happens, you're good. The only negative would be suppose you don't close the short, right? You don't close it and it goes in the hole. It goes in the money, and then on expiration day, you let them assign it. Now you're in trouble, right? Because now you've got issues that need to be dealt with. They're going to hit you with an assignment fee because they automatically assigned you. Then you've got to exercise your call, and that's another fee that you've got to pay. And sure, you end up with the loss, but you ended up with two different fees that you also had to pay and the commissions on all of it. That's like the worst case scenario is the double, right? Yeah, it's always good to work through it because that's how we get rid of the mental block. I thought we only had one. Do we have more than one? Oh, yeah, I got you. Um, yeah, I don't know, man. If you're in another server and you're chatting there, it's going to disconnect you from there, very likely. So with this diagonal, this is the shape. It looks very much like a butterfly, only it's more curved than a butterfly. Butterflies are more rigid, and this will expand with volatility. These break even lines will get wider, meaning our tent for profit gets bigger if volatility rises. But if volatility falls, this thing will get narrower and our window for profit will shrink as well. But this is just one side. This is the call side. So I'm going to turn that off and I'm going to turn on both sides now. And this is what we call a double diagonal. And what I want to highlight is look at the middle. It never goes negative. So our break even is from this red line all the way up here to that red line all the way down there. That's a really wide break even. And we can do that and put it on top of a weekly expected move level, which is really awesome, right? Because it'll cover both sides of the weekly expected move plus some. The difference is, though, on a lot of these kind of trades, you may have to buy to open rather than sell to open, which we would do with an iron condor, right? But this one's showing a debit because of the dates that I used. I just randomly let it assign dates. We would want to use a Friday, Monday expiration, and it should be um, much smaller than that, right? It's not going to be a credit ever because you're buying a back week, and the back week's always going to be more expensive than selling the front week. So, you're not going to get a credit to open, but you spend $1.88 and it's all profit in here. You only start to go negative if we're outside the box. So there's that's where your risk is outside that window. Anywhere inside the tent, you're seeing profit. Even if we don't run at all and we just stay right there, you make $25. It's not fantastic, but it's 25 cents. I'd say, if you're unsure, just experiment, push the button and try to talk and see if you're showing up if you're answering it, if you're hearing it in both. I run two computers at the same time and I have four screens. So I can bring up Discord, on two different computers and look at both of them at once. And that helps to be able to see what's happening in both. But I don't know. I don't normally chat unless I'm streaming. So it's the random volume issue. I've got a noise issue. When people chime in and they're on different volumes and I haven't adjusted them yet, I have to take the time and adjust them. If it's a really crowded room and there's like 20 people talking, I do not like showing up. When I worked on the rigs, I wore ear protection and it's loud. I mean, drilling rigs are loud and noise really didn't seem to bother me. But now I get triggered and well, I'm a grouch when there's just a lot of random loud noise going on. I'm a grouch. I wear earplugs at the races and people laugh. I'm like, go ahead and laugh. At least I'm not beating you down and into the dirt because I got salty over something. What's that? Yeah. I had someone tell me, he says, even though I don't hear you say it anymore, I hear it in my head. I like that. That was good. Like I'm haunting the guy. So these double diagonals, though, they do solve the problem. And I made a video on this. It's on the Bullish Bears website. Just search for the Marcus trade because that's why I ended up naming it. And they're good. The issue with these is you do need some capital, right? Like you're dancing to expirations and your short options, and it requires some capital. But I think we should put one of these on next week for anybody who hasn't had one. I'll get in it with you. It's not like, I'm throwing you to the wolves. And win, lose, or draw, we'll all be in it. And if it needs managed, then we'll manage it as well. Because we're not going to put on a Friday expiry. I think we'll end up putting on a swing trade one, and I mean, look at the range. We can run the probability expected move, say for August. We'll just run it. It's that wide. We can build an August expiry double diagonal, match the edges, and let it run. Worst case scenarios, we have to manage it, and we can do that. We've got 4 options in 2 different expirations. That leaves a lot of room for management. Lots of things that we can do to turn that trade into a less losing trade. Um, I mean, I've known people to run these short term, but this graph only looks good because I went farther out in time. If you're going to try to do it like on Wednesday for a Friday expiry with a double diagonal, I don't think it's going to look this pretty. And by pretty, I mean it could sag down in the middle and these break evens could be a lot closer together. And it's a lot more dangerous, right? Um, if it was me and I wanted to monetize the risk of next week, I would shotgun butterflies all over the place. I would just scatter them around, little $1 butterflies just all over the place because it's a dollar. You know what I mean? Like, and if you're far out of the money, you could make them 3, 4, 5, $6 wide butterflies for a dollar, and just you know what? I've done it. I've done it and had them all lose, but I've done it and had a few win too. So, you know, one SPX butterfly that you pay 5 cents for can net you, $1,800. And damn, that feels good. That covers a lot of those other ones that didn't work. Calendar, I think also a calendar would probably be better, and not a double either, just like a single calendar would probably be better. But being short an option next week into that stuff, probably not good unless it's like a vertical or a butterfly, which is basically 2 verticals anyways. That's what I got for you guys. Unless anybody's got questions, I'd say we wrap it up. But Wednesday, we are going to be putting on a swing trade for the August expiry, even though it's no, wait, I don't stream FOMC days. Whoa, 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 whoa. Next Wednesday is FOMC and I don't run FOMC days. So yeah, Tuesday or Thursday, right? I usually swap with Creed and do Thursdays, but I can do Tuesday. Yeah. Yeah, let's run it. Yeah, let's run it Tuesday. Yeah, I don't know if you saw the chat, right? The moderator chat. Oh, well, he's talking about he wants to come back. So he was he streaming Tuesdays? I was talking not Creed, not Creed, the other guy. The other guy was yeah, he mentioned in the moderators channel that he's looking to get back into things. I'll send you what he wrote. So, well, I guess it's not if he wasn't streaming Tuesdays anyways, then it doesn't matter, right? It's still good. We'll just run it Tuesday and Friday because I don't do FOMC days. I used to, but every Joe Schmo and their brother was doing it, and then we were stepping on people, and we were arguing over it one day. And so, what are we arguing for? Like this isn't worth arguing over. So I just said I'm not doing them at all, and somebody else can do them. Well, then now, like nobody does them, but whatever. The Point is, I'm still not gonna. So I will see you guys then. Absolutely. On my streams, they are open. You guys can chime in 100% through the whole thing. I don't have, like some quiet period. In my morning streams, I don't stop for questions. I just blast through it because we all got things to do. But in these afternoon streams, heck yeah, the more the merrier. Chime in, input, questions, points of view, 100%. Yeah. That was the biggest complaint out of the education series on the option stuff was we have no idea what the heck this guy is talking about. And I told them when I started recording it, somebody's going to have to do the intro that gets them to this point. And everybody said, "Oh, we got that. You just do the advanced stuff. We'll do the intro. We'll get it covered." And it goes from like, "This is a candle" to "Let's do a double diagonal butterfly." Huh? Everybody's just lost, confused. At some point over the weekend, I'm gonna try to get this rate of change built for the rate of change of a moving average because I really see the value of knowing how fast a moving average is moving, if that makes sense. I'm not gonna do it today. I'm just fiddling, getting the pieces of it. A lot of Thinkorswim studies, you can just cut and paste parts and pieces from other Thinkorswim studies. And so I went and captured an exponential moving average and Thinkorswim's rate of change and put the two together. I'll fiddle with the rest later over the weekend. I did a lot of Benzinga streams back in the day when they were running their options boot camp, but I quit doing it when I found out they were promoting those to non Benzinga people, right? Clients who weren't signed up. And so they would gather up all these email addresses from all these people who did not have a Benzinga account, and then they would sell those to marketers. And yeah, what a mess, right? And people were getting mad at me for it. I'm like, dude, I don't have your email address. I don't even know who you are. Why are you yelling at me? They're like, they sold my email. I'm sorry. I didn't make any money out of it. So I quit doing them after that. And I told Lucian I wouldn't go and do them anymore because he was the one that asked, if I was willing to go promote us by doing the Benzinga streams. I'm like, yeah, shoot, I don't care. We run options boot camp on the weekend and it was fun, but I hate having my email bombed. And so I understand people don't like that. Yep. Everybody have a good weekend and we'll see y'all Monday morning for the briefing.